We have Tenaz Energy with us this morning. Tony Marino and Dave Burkhart from the company obviously made another acquisition in the Dutch North Sea and I guess the German North Sea this time to expand their offerings in that part of the world. You know, high netback, long life reserves with lots of opportunity now for exploration with this new acquisition. So pretty exciting. Stock has obviously responded accordingly, and I think there's a lot more to go for what these guys have ahead of them. Tony, I'll hand it over to you.
Okay, thank you so much, Kirk, and that was a very nice write-up that you did. We're excited about talking to the entire group today. I'll let you know I'm in Amsterdam right now. We're at actually the office of our partner, the operator of this project called One Dias, and having a series of technical committee meetings today about each of the assets. It has been a busy week. At the beginning of the week on Sunday, we went to the platforms, conducted an inspection, and met the team that was on site that day. It's actually normally a automated or unmanned platform, but because of some work that they had going on, we were fortunate to be able to meet the people that run the asset as well. And I've got to tell you, it is a super impressive installation, truly state of the art, truly automated, almost using artificial intelligence, I would say, in some aspects of the operation there. So it was a great pleasure for us to be there, and certainly it met all of our requirements in the quality of the physical asset. And then we signed and closed the deal on Monday. A sign and close rather than one of these long periods between signing an SPA and then executing the closing and therefore transfer of the ownership. This one occurred on the same day, really possible because it's a non-operated asset for us. So we're going to briefly review very quickly the deck that we created specifically for this acquisition, and I would encourage you to ask questions along the way. We have a disclaimer at the beginning and the end, so we can page past those and just go to the summary slide. Yeah, so you know the model of the company, international acquire and exploit. If you count the original recap transaction, we have made 3 smaller deals, 2 non-op in Netherlands, 1 a small Canadian expansion, and then the 2 significant deals in Netherlands, NOBV, which has become TEN, the old offshore NAM assets that we're the operator of, and now this quite significant non-operated acquisition. With these, we do believe that we are probably the largest producer. We think we're the largest producer in Netherlands, with the exception of the state gas company named EBN, which has a 40 to 50% share of all licenses. They participate on a heads-up basis, and they're quite a good partner to have. But among the non-state owners, we are probably today number 1 in the Netherlands. And in fact, we might have been even immediately before the GEMS operations. Some of the other assets, non-Tenaz assets in the country had declined to some degree. So I think even before this, we're in the number 1 position. We do expect GEMS to grow a lot, so we will probably be maintaining that position along with organic growth that we'd have on the operated asset. Market cap, actually, as shown here, really prior to the acquisition, we had a bit of a move up in the stock. So we're in the range of $750 million right now, CAD. I guess our EV has crossed $1 billion with $400 million in debt. Following the acquisition, had been 100 before. That 100 million previously was mainly comprised by the earnout obligation as we estimated it to NOM, kind of a conservative way of accounting because the earnout really is non-recourse and non-interest bearing, but nonetheless we had our estimate for that that we owed to NOM out of the NOBV deal recorded as debt. what we call pro forma production, a little bit over 16,000 BOED. Vast majority of that, 90% of it roughly, is TTF gas. When we say pro forma in here, we mean had we owned the asset set for the entire calendar year 2025 prior to closing, both for NOBV and for GEMS, and our estimate after closing. The E&D CapEx will be a little bit over $100 million. All that is only counted after closing, as it would appear in our financials. And so ready now for the next slide in the deck. Just a quick summary on this. I think you've seen this in various stages of updating previously. Substantial growth really in production, cash flow, NPV of the reserves per McDaniel's independent reports in the history since the recap. Moving on to the next. Capital structure, we just kind of waterfall the debt down. Again, we discussed this earlier. The earnout was the main component of our debt previously, included both in current debt for the portion that is estimated to belong to the 2025 period payable next year, and the remainder long-term obligation. Now we have the additional debt that we take on in part to pay for GEMS. The table on the lower left, I think, is an interesting one. That really details the two tranches of notes that we put out. The first, November of last year, November 2024, which was designed, had we needed it, to pay for NOBV and to provide dry powder for the future. We ended up really not employing very much of it there. We produced a lot of cash flow out of NOBV right up to the closing, which really brought down the amount that we had to pay at the time that we closed. That was a $140 million tranche private placement in the Canadian market, CAD notes, 5-year term, 2-year non-call, par bond at the coupon. The second tranche is what we used in part, along with cash on hand, a lot of which came from the first tranche, to pay for the GEMS acquisition. And this was a $165 million principal. It's really just an add-on to the first set of notes, so it also is a 12% coupon bond, however, issued at a premium, 8.4%. That provides on that tranche a 9.5% yield to maturity. All the things about that bond are really the second tranche are really the same as in the first. The indenture, even the maturity and call dates. So we keep those the same. I think roughly you'd call this new tranche a 4.2-year, 1.7-year non-call bond, and it'll give us the same maturity date of November 29 that we had with the first tranche. But again, it's really at a lower interest rate, although the coupon's the same. Very important, issued at a premium, so that it's only a 9.5% yield to maturity. And I do think that that's a reflection of the current credit quality of Tenaz. We've always felt it was very strong. Nonetheless, starting as a small company with a private placement of bonds, we had a higher interest rate at the beginning, and we have a lower one reflected not quite 1 year later. In the middle of this lower part of this slide, we talk about the new revolver that we have. Previously, we had let it expire, but we had a $20 million revolver from National Bank. We never really drew that for a significant period of time. We have established a new reserve-backed secured revolving credit line. 3 banks at present in this for $115 million. We signed this at the same time that we did this transaction, and roughly the same timing as a private placement of notes within a day or so. And this is designed just for additional liquidity for the company. It's undrawn at present. It's got all the terms that would be customary for a secured RBL. And it's a typical structure in that there's a pricing grid to get your credit spread versus index. If drawn in CAD, it's one index, and if drawn in USD, it's a different index. It's undrawn right now, but were we to draw in CAD to give you an idea of the rate with our current debt to EBITDA that we have, it would bear interest at about 7.13%. Share count, we don't record any change there. As I'll speak to later, we have a small amount of equity that goes out in this as a result of financing this purchase that went to the seller. That's not reflected in there, but it's pretty minor. It'll be 2 to 3% of our float. And we have the metrics on the lower right. I can't read everything on this slide because it's very small the way it's oriented on my phone screen here. But I'll point out, I know these numbers pretty closely by heart. The GEMS acquisition, just a little bit over 2 times cash flow. It should pay out on an ATAX basis in less than 3 years at the strip with our forecast that we have for the assets. And our combined company debt metrics on the very lower right of this slide, about 0.9 times debt to EBITDA, and after this deal, based on 26 estimated EBITDA, and current, well, at the time of the day, a little bit less today because of the move up in the stock, but if we take EV, it was 41% at the time of the deal. And please correct me if I read something wrong off these slides, doing them sort of from memory. David, if you would move on to the next one, please. This is a reserve summary for the company as a whole. When we do an acquisition, we're very careful in the evaluation of it. We do an internal evaluation using our internal set of engineers and geoscientists, really every discipline represented. We estimate the performance of projected performance of every well and every project that is available. We do it at putting it into the same RCADs that you would have in an independent report. At the same time, when we think a deal has a reasonable degree of probability, we engage our independent reserve firm, McDaniel, extraordinarily strong firm technically, in my view. And I think the largest of in terms of Canadian market share for the Canadian reserve firms. We engage McDaniel to do an independent report. In this case, we've got a 2P report plus a prospective report varying in 3 pools that we went all the way to economics, a number of other prospects just done volumetrically, and a contingent report done on the basis of volumetrics for some discovered pools that don't have a clear path to tie-in. But we had McDaniel do reserves, prospective resources, and contingent resources. What you see on this slide is the result for the 2P report, shows the buildup in company reserves, and McDaniel's forecast at the 2P level of growth in production that for the pools that could be recorded at the 2P level. Now, in this asset base, we'll see it on a map in a minute, there are 3 pools that have been discovered that will be already been discovered that will be developed either from the existing producing platform called the N5 platform or the subsequent platform that we believe will be in place 27 for production in 28 called the N4 satellite. So only 3 pools that have already been discovered and would be tied into that platform are included. And that is all that is reflected in this production forecast. There's quite a bit of opportunity beyond that. We'll try to make a representation of what its potential is later on in the presentation. Those are those pools mainly that belong in the prospective category because while they're pretty high chance factor prospects, typically in the 80% and plus range, they cannot be included until they are drilled and tested. So a pretty limited set of pools that can be included appropriately in the 2P report, and that's what McDaniel has represented here. If we move on, please. So, in talking about the acquisition, a few things I want to point out. First of all, the map is quite critical. Uh, you can see where this set of assets is located offshore North Sea, pretty close to shore typically. Usual distance offshore probably averages 25 or 30 kilometers for most of the main development area, and usually about 25 to 30 meters of water depth. So shallow, pretty decent weather area, actually, relatively mild, I would say, by North Sea standards, right on the Dutch-German maritime border. The current platform and the next platform that we intend to place in Dutch waters and prospects, pools on both sides of the border. These are the orange lands that we represent there. The other blue licenses are those that we already had an interest in, mainly through the NOBV acquisition, which we now call Tenaz Energy Netherlands. Those are the ones shown in blue. It's a great set of assets, and just briefly speaking to the attributes that we list here, we think really overall it's probably the highest quality asset base that we could find in Netherlands and UK at least, and perhaps it's in the whole North Sea. But in the areas that we've been most active in making evaluations with, it's the highest rate, and I'd say highest margin, probably highest rate of return on exploration and development activities that we have seen. It includes the highest rate well in the Netherlands, 77 million cubic feet a day, ramping up a little bit over the past few months in production. That's the one well that is on production through the N5 platform. It's very high margin. There are no royalties in the Netherlands. There are a small royalty, 5% of revenue minus OPEX on the German side. So composites out to a very low royalty, even on these pools that span the border. You've got the TTF price, super high rates, automated platform, so low OPEX along with that high prices and very low royalties, so very high margin. There's a lot of growth possibility for this assets, as a set of assets, as I mentioned earlier. Also, very interestingly, we'll show it on the map later, but it's got a very, very low emissions profile as a result of being powered from the Riffgat wind farm across the maritime border in Germany. On to the next map, please.
Does the GEMS portfolio have hedges attached?
Yeah, we have hedged for the existing production. We've hedged in the range of 40 to 50%. This is detailed in the presentation. Some of this we've already done, and a little bit of it is ongoing. Will be completed shortly. From now until the end of 27, for this meaningful base percentage of this existing production. Now, production is going to ramp up further, and we'll add to these hedges. These hedges done 30 euros a megawatt hour plus, which would convert in Canadian dollar terms to 14 or 15 dollars per MMBTU. So at very, very strong prices, and we're going to continue to hedge it as production increases. I'm going to go through a little less detail on each slide to move us through it a little bit faster, but we detail the license interests at the bottom of this slide, ranging from 22.5% to 45%. We have a 33.3% interest in this existing N5A producing pool and well. That's a well making 77 million cubic feet a day into this very strong market. The existing pools that are in the reserve report are shown on the map here in the pink or rose color. N5 pool that currently produces into the existing platform. There'll be a couple of development wells drilled on this beginning probably later this year. There'll be an extension prospect drilled from there and an exploratory prospect as well. The N4A and C pools are the orange ones, or rose-colored ones to the north of that. Only 3 pools, N5A, N4A, N4C, were included in the reserve report because they have been tested. By the way, the test rates on the N4A and N4C pools were also very, very strong. 50 million and 20 million cubic feet a day on the exploratory wells that were drilled into those. The whole area in the 1DOS era has been drilled at a very high success rate, maybe not quite 100% in finding these new pools, but virtually all the wells that 1DOS has drilled on the current license area have been successful. There's a few contingent pools shown in the orange color, and a number of prospects, contingent meaning they have been drilled and tested previously, but they're not planned for tie-in within the existing first couple platforms, and a number of exploration prospects, some of which are quite large. So if we move on to the next slide, I'm going to go through a little bit more quickly. Geology shown here, quite continuous. It's a basal Rotliegend sand. This is kind of the mainstay of the Rotliegend is the mainstay of the Northwestern Europe gas industry. Very consistent over 40 or 50 kilometers in finding reservoir quality sand. The area is covered either by 2D or 3D merged data set with this well control, and I think pretty well understood, pretty well mapped even for the exploration prospects, and that's why there's been such a high success rate. Next slide, please. This is a picture of the platform that we were at on Sunday, state-of-the-art platform, automated, runoff of electric power, and will have the long-term connection to the Ripcat wind farm on the other side of the border. This will be the place where we have the next 4 wells drilled from in this first phase drilling program, and a platform capacity gross of 225 million cubic feet a day before any expansion or optimization, and we have about a 1/3 interest in this initial pool and extension prospect being drilled. Next slide, please. This gets into some of the same discussion that I've already had. Development wells in the existing N5 pool. That's the pool again with that 77 million cubic feet a day a well. I know I mentioned that a lot, but when you're making 77 million cubic feet a day into such a strong gas market, it's pretty notable. We'll have a couple of development wells. We'll have the N5 North extension prospect drilled, and probably an exploratory well drilled in the next part of the program. And this, again, the platform has capacity for 225 million a day. And in this collection of prospects, we'll have a 1/3 interest or higher. Next, please. Next phase of development, we're going to be placing a platform called the N4 satellite. This is the plan to the north to develop those N4A and N4C pools, and potentially exploration off of those as well. There's a number of targets that we could hit from here. Hasn't been an FID decision yet, but that'll probably occur in 26. A very rough schedule would be to probably place a platform in 27 and do drilling and be able to produce during 2028. And that will be tied back into the N5. I didn't mention it earlier, but the gas goes into the NGT system that we own 21.4% of already. So there's when this field ramps up, we get a midstream component of revenue as well. The the N4 satellite platform is planned to be reusing a topside from a decommissioned field, decommissioned block in the Netherlands. So there's even more reuse here of equipment, making it even more efficient in terms of the use of resources. Next slide, please. Okay, so here we detail to a greater degree the future development and exploration. Again, what I mainly want to point out here, you can look at these volumes for yourself. They're pretty significant. We split the more important piece between the prospective and contingent a little bit in reverse of how it typically is the prospective piece. We asked McDaniel to evaluate 14 prospects. 3 of these, they took all the way through a complete economic analysis, showing this 300 million adder potentially on a risk basis to our net value. And 11 of them, they just did volumetrics. We made that distinction between the 2 sets of exploration prospects that have prospective resources, because it's those first 3 that we have the nearest term, I think, schedule for drilling. And also they're proximal enough to the planned, the existing platform and the new planned platform that it was reasonable to have a full economic analysis based on McDaniel's assessment of these prospects. The other 11 just volumetrics, quite significant on their own. Next category, in this case, I would think of it maybe a little less important. The contingent pools, there's been 4 of them, a couple of large ones to the north, a couple of smaller ones in the southern part of the license area that have been discovered and tested, but not such a near-term plan for tie-in. It'll take further economic analysis of that to get to that point, and for that reason, not in the reserve report, but in a contingent category. Next, please. Acquisition summary. We have here the breakdown of consideration. There's really, I guess, 3 components to it. Cash consideration of $232 million US, equity of $12 million US, with the number of shares based on the 20-day VWAP after signing. So Monday was the first day of trading for that, and whatever our volume weighted price for that 4 weeks starting last Monday ends up being will determine the number of shares issued. It will be, we think, less than 3% of our current float. So those are the base elements of consideration. The contingent consideration is based on exploration success. There are very good prospects, so there's a fairly reasonable chance, I think, that some or all of this will be paid. Up to $320 million US payments if large 50 BCF or more recoverable discoveries are made within a 10-year period. That extension prospect is the one sort of exception. If it proves to be part of the same hydrocarbon accumulation as the N5 pool, but has 50 BCF of incremental, it'll qualify for a 10 million payment. If it's completely separate, it'll qualify for a 20 million payment. But in any case, all this compensation would come in after we begin to produce those pools, and they've been demonstrated to have large size, these exploration prospects. The metrics for the acquisition, if we take an estimate of next year's production, only partially using the capacity on the platforms and drilling development wells in that N5 pool that are less productive than, certainly significantly less productive than the existing well, use that as our number for 26 production, 7,000 BOED net to us, all TTF gas. We'd have a metric of about 48,000 Canadian per day barrel. I actually can't read the bullets, David. Maybe you could help me on these next two. I think 2.1 times FFO, and I guess the last one is probably payout as well, less than 3 years if I could read those correctly there.
Yeah, you got it. That's correct.
So on to the next one, please. This is just a reserve breakdown at the 2P level, just those 3 pools by McDaniel. It's been subsumed into the earlier full reserves for the company, so we skip that and go to the next, please. This is where we're attempting to give some perspective on the potential of the assets beyond just the 2P 3 pools that we talked about, showing the kind of change in volumes and potentially change in production levels using the existing capacity of the system without any further expansion, showing that there is a potential for growth if there is success in these other as yet undiscovered pools to bring us up close to the overall capacity that exists in the system today. And again, there could be facility expansion from there if there are a number of if there is this continued success in exploration. Next slide, please. Yeah, just for this guidance and hedging, we have very heavy emphasis now on TTF in our product mix. On this pro forma basis, we talk about nearly 90% TTF activity. we drilled our Canadian wells, quite successful program there. We continue growth in that asset. It's detailed in the corporate presentation. We'll have some non-op drilling in the legacy Netherlands before non-offshore. We will develop non-offshore, beginning with a drilling program in Q4 and a barge program as well to do workovers. We think we're going to have very good growth out of NOBV as well. We will have the GEMS activity with some capital assigned into it for the remainder of this year as we begin drilling and some of the additional platform CapEx activities. We will have a little evaluation of carbon capture, continued evaluation of carbon capture, so a little bit of CapEx that goes in for that evaluation on the existing assets in Netherlands, and we'll continue to evaluate acquisitions in Netherlands, Europe, and elsewhere. New guidance for the company, because we can only count the production and CapEx after the closing date. We rounded down to a 500 barrel a day addition to our production guidance for the year, and added about 15 million of capital to our capital forecast. Hedging on the last slide, last slide I'll cover here. We will, as we discussed earlier, we'll already be hedging 40 to 50% of the production that we, on the next slide there, that we expect out of GEMS for this base level of production, and we'll add to the hedges going forward. Again, the typical hedge price right now is in this 30 euro per megawatt hour range. For the swaps, some of the collars 30 by roughly 37 range that we've been putting on recently. That 30 price would again correspond to something around 14 or 15 Canadian per MMBTU. So we got our final summary slide, but I've really hit most of these points earlier. We think that we have acquired you can just go to that very last summary slide if you would please, sir. We think we've acquired a very high quality asset, very good cash flow and free cash at the same time it grows with pretty good development drilling opportunities and pretty high COS exploration prospects, we believe. So we'll throw off free cash, we think, even as it grows in this very high value market. And we think everything that we have done with this GEMS acquisition is consistent with the acquisition strategy that we're already outlined that we set out at the time that we started Tenaz. NOBV was a huge step in that regard. It throws a great value deal, throws off free cash at the same time that we should have meaningful ratable growth out of it. GEMS is a higher capitalization up front for the acquisition deal. It has very high growth rates. It will throw off free cash while it is growing. And the combination, I think, can lead us to have very significant production size for the company in this market, hopefully getting us, moving us into more of a mid-cap range ultimately for production levels. And we'll continue to try to execute the acquisition strategy as well in other assets over time. So that is my summary, and would open it up to any questions that you might have.
Tony, maybe I'll start.
Yeah, go, Kurt.
Okay. There's been a fair bit of talk in the recent months or so about the potential for LNG on a global basis, LNG supply outstripping demand to force global LNG prices down a little bit. Wondering about your thoughts on that and potentially the impact on TTF pricing, and then if you are seeing potential softening in the TTF market, if you guys would then be a little bit more aggressive to hedge sooner rather than later, I guess ultimately is where I'm going with that question. So I'll leave it.
Okay, super. Yeah, the question about the fundamentals, I mean, it's a great one. There is a steady LNG build. It's already going on. Projects mainly in the U.S., a series of trains in Qatar as well. And it's going to expand the supply of LNG that is available. On a purely fundamental basis, supply and demand, the sources of additional demand, I think, can occur certainly in Asia. They're not necessarily having to be China, but in a number of Asian countries, Japan, Korea, Taiwan, India. There is and others, in fact, there is, I think, a decent growth market. China may be as well. We'll have to see over time what portion is provided via pipeline, if they can get some additional projects built out from Siberia, and what portion comes from LNG. But Asia is a pretty good growth market, I think. Europe, demand took a hit after the high prices that came in with the the post-COVID and Ukraine war run-up. It has stabilized. In fact, I think there's some prospect that there will be increasing demand in Europe for industrial uses as Europe reindustrializes in areas such as defense and data center development as well. So I think European demand can come up at the same time, maybe at a lower rate than in Asia, but in some other places in the world that have some scope for additional LNG uptake too. I mean, one example might be Colombia. So there's a few other places. It's not just Europe and Asia. Again, mainly Asia, more so than Europe. So that's the demand side that would go with the supply. There's been increasing LNG supply for decades now, actually, and this gas has tended to be taken up, because of the desirability of gas as a fuel, some of it via power now being translated in even as a transport fuel. Of course, there's renewable growth at the same time. So there's a variety of energy sources available, but in general, this LNG growth has been absorbed. There's the known schedule that we have for 25, 26, 27, 28 coming out of the U.S. plus Qatar. And the best way that I can answer this is to sort of look at the overall price performance. We talked about the levels that we have been hedging at through the end of 27. It's in the range of 30 euros per megawatt hour. So while the forward curve does have some decrease reflecting this additional supply, which seems appropriate, it also maintains prices at a pretty good level. And of course, you're going to have a pretty significant premium, for example, to Henry Hub prices to pay for all of the steps in the NGL process, tolling, transport, regas, etc. So that is the forward curve as we know it, and to us, it's the most reliable indication that we can have of where prices might be. The real near-term picture, I guess, is storage isn't particularly high in Europe, a little bit lower, particularly in Germany and Netherlands, than it usually would be going into the winter. We'll see how the weather is to see if that ends up being a kind of a upside pricing problem or not. Probably European uptake of Russian gas, and there still is Russian gas that comes in via LNG and some pipeline import. To me, it seems like that is headed for zero over a couple-year period. So there's another increment that will need to be replaced, and I guess that's probably part of the forward pricing picture. So this is what the market is telling us about the long-term opportunities. We are hedging out to the end of 27. Typically, you're going to see us about hedge for the next year, 26, and then 50% hedge for the next year, and then a somewhat lower percentage. But if we become more wary of this longer-term outlook, you would probably then, as you're suggesting in your question, see us hedge more in 27. So we'll be very attuned to it. We've got a very strong risk management program in the company, and we could consider even going out further down the curve if we thought it was necessary.
Excellent. Thanks, Tony.
I think we're going to have to wrap it up there. Obviously an excellent presentation. Our clients given extremely positive feedback to this move, and obviously the market has agreed. But we're going to get back to the desk here. But thank you very much for your time. It's excellent.
Okay. Thank you so much. Goodbye.